Very good. I have more questions, but I'm going to defer to the audience's questions first.
Yeah, we've got some good questions, I think, coming in, Erica. Maybe you want to take them in whatever order you like, and I'll try to address them.
Absolutely. There are some very specific to ESG ones. So I thought maybe, we could continue the momentum with some of those. Also, I think that these were some of the first ones to come in. We had Ricky ask, is there any factor loading in investing in ESG? Maybe momentum, given there is behavioral and political push in our society to invest in these companies?
Yeah, Ricky, that's a great question. In general, as a broad statement, companies with high ESG scores tend to be growth companies and not value companies. And one reason is a lot of the value companies are things like energy stocks, mining companies, et cetera. And they're naturally going to have poorer scores if you consider scores against the market as opposed to the way I think is a better strategy of best in class. So you do see that. A second point you touched on yourself, which is right now you're seeing massive cash flows into ESG stocks. So you're getting what you might call ESG momentum, and that can drive returns. And as I mentioned, green stocks have been outperforming at least until this year. Now I'm sure, I know I haven't looked at the data, but I would bet brown stocks are outperforming because the energy stocks are doing so well. But my favorite approach to answering your question would be, if you want those exposures, that's exactly what the dimensional sustainable strategies do. They tilt portfolios to the factors with higher expected returns, and they screen out stocks with negative momentum. So that would also help in that way. And I will say this, the funds that we use from Dimensional and other fund families have more ability to have deeper exposure to these factors than the sustainable funds do. But the sustainable funds have some exposure to them. I'll just make up a simple example so everyone can follow what I mean by that. So if you're running a total market fund today, it might have a price earnings ratio of 20. If you're running a value fund, like Vanguard, it might have a PE of, say, 13. If you're running a value fund like Dimensional, which is much deeper value, you may have a PE of 10. And there are some funds that we use, particularly in small value, where the PEs are even lower. And so if you want those higher expected returns, you might seek to own the funds with the lowest PEs, the lowest prices to cash flow, et cetera. Dimensional's sustainable funds are, have some exposure, but not as deep exposure as their funds that are not sustainable directly. So that's your choice. You can lean one way to say, which I think is a perfectly good strategy, I'm going to shoot for the highest expected returns. And let's assume I think that'll get me, just to pick a number, 1% a year more. And then I will take that 1% a year and donate that money every year to the charities and causes that I believe in the most. And I can have a direct impact knowing that on those causes. That's one strategy. The other strategy says, I want to express my values. I'm willing to accept a slightly lower expected return to do that and drive corporate behavior. That's fine also. So I think you have good choices here, and a good advisor can help you weigh those choices and figure out what is most important for you.
And I should defer to the audience, but I have to ask one more question, which was a follow-up of the answer that you gave for the first question, because I experienced it in my own business. So our business is 35 years old. We have a couple people who have been with us for more than 30 years. Few people are retiring. Our business is growing. So between the people retiring and the growth of our business, we've had to hire a bunch of people, both CPAs, attorneys, and support professionals and marketing professionals. One of the major emphasis of our business, particularly of our writing, is actually charitable planning. And in our books, we have a number of chapters on the most efficient way to give money to charity. We have chapters on charitable remainder trusts, et cetera, et cetera. And one of the very frequent selling points of why and I'm looking for really good people, like our CPAs that we've hired. They are both 8 to 10 year, actually one closer to 20-year experience, super sharp, really quantitative, the kind of CPAs that we need to do the kind of work that we do for the strategies and the Roth and the gifting and running the numbers, et cetera, et cetera. The truth is they can kind of pick whatever company they are, and we can't compete purely on the basis of salary and benefits, but they like the idea of doing the kind of work they want to do and doing it for a company that is promoting good things, that is charity, et cetera. So where your comment about people, the labor pool being very tight, the particularly younger workers want to work for companies that have expressed and are actually doing good things is very important. So now here's my question, Larry. You've always been a science, evidence-based guy, not a gut instinct guy, all right? What you just said about the labor force wanting to work for socially responsible companies, that is very consistent with my gut instinct. Is there some scientific-based evidence to support that statement?
Yeah, there are papers on that. We actually talk about that in the book as well. So that's the good news. The theory holds up with the evidence. Companies where employees are more satisfied, and that they're more satisfied because they're working for companies that express their values, those companies are more productive, or the employees are more productive, and the companies are more profitable. So it pays to be a good ESG citizen because you will attract better employees. They'll be more satisfied. That'll make you more productive, more profitable, and that'll help your stock price and raise your stock price, which means you have a lower cost of capital. So all good news here.